All right, welcome back to OK Computer. I am here with my good friend Rick Heitzmann. He is the managing partner at FirstMark Capital. Rick, welcome back to the pod.
How's it going, Dan? How's summer been?
You know what? You and I got off to a very hot start in the summer here, and we had a little Springsteen in Hyde Park. We did a little F1. We did a little celebratory action in some other areas, and then I feel like we've just been we haven't really connected.
I had to go back to work.
I know we did. We had a hot week and a half there in early July, but we're back, baby. Lots to cover here, man. I wanted to kind of do a little bit of a heat check on the private markets. Debo and I just had a great conversation, just kind of taking stock of, Q2 earnings season and what we heard from some of the biggest drivers here. But I also wanted to get a sense of kind of what you're thinking here, because, when we think about everyone's so optimistic as we get into a new year. We just got through the midpoint of the year, and it's been a great year in the public markets. It feels like there's still some trepidation in the private markets, whether it be valuations. Like my inbox over the weekend with the information, there was a whole host of articles that just got me thinking here. One of them was venture firms still writing small checks, unicorns, fire sales, tidal wave of down rounds hit startups. And just, I just mentioned the word optimism, but we started out the year, there was a ton of pessimism about the private markets. I think in the public markets, people were ready to turn the page. So let's do a mid-year sort of pulse check.
Let's do the temperature check. What's the pulse check? What's going on? Probably flashing back almost 2 years ago, going into Labor Day 2021, we were throwing up every red flag we could find, saying this market is so overheated, it's going to break. It's going to bust soon. We didn't think it was going to be in a month, but it was. And then, last year, and through all of last year, there was an increasing pessimism that I think some folks held on in the venture markets and the private markets through the first quarter, even through the first half, on the expectation it's not going to be that bad. But I think we were telling our listeners that, hey, it's going to be that bad. And, if there's a long party, there's a long hangover. So there's going to be an equal amount of time it takes for recovery as it took during those boom times. And, it's not going to take the 12 years of a booming venture market, but there is going to be a time of recovery and there is going to be a time of renormalization. And especially because a lot of the entrepreneurs hadn't lived through. And actually, frankly, a lot of the venture capitalists hadn't even lived through a downturn before. So now we're at a point where we got to figure out what to do. Earlier this year, I think there was a lot of pessimism, and I think that changed right around the beginning of Q2. I think we had the end of Q1 pulse check, temperature check, and I said, hey, it feels like things are starting to move again. It feels like there's been a normalization of deal dynamics, valuation expectation, and a sense of we're going to start seeing the gears move. And it always starts with two things. It always starts with some kind of reason for people to be optimistic. And probably in the last 6 to 9 months, it's been AI and generative AI in particular. And what you're seeing is, hey, this is a new fundamental change. And this is going to be maybe the next wave of innovation that we're going to see globally. The second thing is, hey, the best is also going to be led out by the best companies. And whether that's in the public market or private markets, we're going to see the best companies get financing done. A lot of the great companies in our portfolio got great financings done because they had great revenue traction. They had great teams. They were participating in great markets, whether AI or elsewhere. And those were actually competitive financings at a time where a lot of people were accusing, venture capitalists of kind of tending to their flock and not looking externally. And so now where we are is, there's still probably a lot of sick puppies. And, as you alluded to, you started to see some of the unicorns who were worth several $1 billion be sold for a couple $100 million. And you're starting to see some of that come out of the system. And I think the next 6 months are going to be some of those companies which might have had an old business model, and we'll call it by name, Hopin, which was really designed for the virtual world. And now, as all of us are coming back to in real life, is probably not that important, and probably overbuilt in terms of the things that they were doing. So, how does that company then? They sold to Ring Central for a couple $100 million. Obviously, had some IP, had a good audience, but is not going to be one of the next great companies. So, both entrepreneurs and VCs are realizing that it might be time to recycle our time and capital. And, that's starting to work. And then as those entrepreneurs either leave companies or sell companies and come back to the market, what they're doing is they have much more realistic expectations than they had in 2020 and 2021. After, frankly, even at FirstMark, we were a little bit slow last year as it was really hard to get to deals, as pricing expectations hadn't adjusted, even though we were willing to and aggressively thinking about getting the best deals done with the best companies. It was hard for that trade to cross. And I think this year it's been much different. I have 2 signed term sheets out there of deals that should close in the next couple of weeks. I think the firm is acting similarly aggressively. And I think that, we're still in a market where people have those much more realistic valuation expectations. So, the venture market, just as it lagged the public markets going into this downturn, it's also going to lag the public markets coming out of the downturn. And what you're going to see is the thing that really drives venture capitalists' egos and confidence is liquidity. And so, until you start seeing great exits, and largely a lot of the best exits are driven by the public markets. So until the IPO markets reopen, you're really not going to see the capital spigot turn back on. But in the interim, I think you're going to see a kind of a renewed optimism and people picking their heads up and thinking about what's next.
All right, so that's a really great point here, liquidity, right? And so when you talk about just the private markets lagging the public markets, we also talk about a lot, or you'll hear economists and strategists talk about the lag of the just tightening of liquidity. We had this amazing period post, financial crisis of just, unlimited liquidity, and then we had this pandemic, and we threw $5 trillion of fiscal and monetary stimulus at that, right? And then we saw this absolute explosion, right, in asset values in the back half of 2020, first half of 2021. And again, you should, great
wild
term.
Speculation.
Yeah, but I think you just named the pod here, bro. The longer the party, the longer the hangover here. So if you think about a little bit the lag effect of interest rate hikes that came to battle the inflationary pressures of all that liquidity, okay, so we have a NASDAQ that's up, nearly 40% or so. That's the NASDAQ 100. With the S&P 500 that's up, 17 or so percent, down a few percent from its recent highs here. There's a lot of folks saying that the leading economic indicators are likely, we've had this recession pushed off, but they're signaling a slowdown right now. Okay. So the lag effect of all that tightening is going to work its way through at least the public markets and the economy. Are you expecting the same? And does that maybe push out those exits, right? Does it push out the IPO market, opening up again if we were to see, let's say, the NASDAQ and the S&P come in a little bit? And I wonder also, does that make it more likely that we see maybe some strategic M&A as the exit, platform that is more attractive, let's say, to companies, because that's where you can get some of the valuations, whether they be public market companies that are trading at 30 times that were trading at 16 times, a year and a half ago, and they have the currency to kind of make some of those acquisitions in the private markets.
So I think he asked 2 questions. First about, are we going to start seeing M&A exits? I think we will, because I think that there's a lot of private companies that are dying for liquidity, both from the investor side as well as the entrepreneur side. And you are seeing a very strong public market, stronger than the private market. So the relative valuation is going to benefit a lot of these companies. Large cap companies are largely being held hostage by Lena Khan, but some of the smaller companies and doing some strategic M&A seems to be in the cards, and we've even seen that in our portfolio. The first part of your question, and I'm answering in reverse order. The second piece would be a conversation we had at our partners meeting. I know sometimes we talk here about let's kind of open up to what we might be talking about around our partners table. The second part of that is companies are still trying to titrate what it means for their business model and what it means to, it was all sales and marketing all the time. It was grow at all costs in 2020 and 2021. And then, demand dried up, the cost of capital skyrocketed 18 months ago. And they said, all right, well, how do we build a profitable business model? As that was happening, they were cutting different pieces of the business. Also, sales cycles elongated as everybody else was concerned about their cost of capital and being capital efficient. And there was just a bunch of things moving around. And I think we're now at a point in the cycle, a little over a year later, where we're really starting to understand those businesses better. And sometimes you take costs out, you take too many costs out. You're not showing the right go-to-market strategy. You're not being the most efficient. You might overshoot or undershoot. And now I think, at least in our portfolio, that we're seeing those companies be able to really get to the fine knobs and dials and really understand their business model in a way we probably haven't seen in a decade of, hey, we're really thoughtful about how we use capital. We're really thoughtful about our long-term model. We're really thoughtful about our costs. And we're really getting to a place where when they become public companies in the next year or two, I think they're going to be much higher quality public companies.
Let's talk a little bit in that partners meeting when you talk about how you kind of allocate capital. This whole notion of dry powder, right? So this was the story and the information. We'll put it in the show notes. Venture firms still writing small checks despite $271 billion in dry powder. And it also feels like, Rick, that every VC that I know, not only do they have dry powder, but they're out there raising capital too. So I'm just curious, what does that mean for valuations here? We talked about the unicorns that were minted in 2021, 2020, or 2020, and having a hard time here because maybe the business models just, they had that acceleration, but then, the interest in the markets have just moved on to kind of sexier sort of themes, right? A little bit. So it went from consumer and digitization of everything, and we're all stuck at home and all the, all that sort of dynamics to things that are really ultimately going to be powered by machine learning and AI and that sort of thing. And it just seems like it seems like the page has turned a little bit. So talk to me a little bit on the dry powder front. It seems like a lot of VCs are ready to move on from some of the things that they were allocating capital to in that whole kind of excitement.
I mean, all the VCs who are, in Web3, then in crypto, now are AI specialists. Maybe they spend a little bit of time.
It's a good meme. It's a good meme.
Infectious diseases in early 2020. People have moved on. So there's a concept of dry powder, and there's about $171 million, someone calculated, of $1 billion of dry powder in the venture ecosystem. And people are always saying, hey, that money has to be put to work. But if you go back to the early aughts and the echo of the large fundraisers in the late 90s, a lot of that money dissipated. It was either, maybe it was a sidecar of a public fund that then got reabsorbed into the public fund. Maybe it was a family office who stopped making these types of investments. So some of that capital is not available. And, good friend of the pod, Josh Wolf, has the concept of wet powder. So what really, how much capital is really available? So you take that big pie of a huge headline number, then you say, hey, well, some of that capital will kind of go away. Those funds might get shut down. Those funds might get downsized. And then there is this pot where we're unsure how big that is of companies, firms just supporting their companies. And they're just saying, hey, I'm not going to look at new deals, but I'm trying to get these companies right, especially our best companies and our winners. And I either have to play offense or defense to support those companies. And especially for the biggest funds, that's a sizable amount of capital. And whether it's they're kicking the can down the road because they don't want to revalue a company or they can't figure something out, or there's a financing round where they have to either protect their position or play offense, all those things not only chew up general partners' bandwidth, but it also chews up their capital. And then, once you get through those two pieces of triage, then it's actually the dollars to put to work. And I would still say, in talking to my friends and colleagues and other managing partners and GPs out there, I still think there's a lot of sick puppies. I still think there's maybe a little bit more fear than greed out there in the market. So although the machinery is starting to work, I think a lot of people are spending time with their existing companies and they haven't really been as aggressive, except if they, believe that generative AI is the next big thing and they're going to pile into a trend. But I think you're going to start to see even some of the larger mega trends that we've invested in over the last 10 years that we think will persist. Things like consumer marketplaces, things like digital health, and health being the largest part of our economy, the fastest growing part of our economy, but the tremendous laggard based on technology and our ability to use digital to provide both a higher quality as well as low cost healthcare is a trend that we're going to see for probably the rest of our lives. So we're going to see these mega trends will persist. There'll be great companies built out of those, and hopefully people are paying attention, not paying too much attention so they'd want to compete with us, but paying some attention because otherwise they're going to miss some great companies.
Hey, I want to switch gears a little bit because there was a blog post over the weekend from our friend Packy McCormick at Not Boring. He is a relatively new VC who made his bones. I think we all became aware of him because of Twitter and his I think prolific blog. And he had a post called WTF happened in 2023. And I kind of want to bookend it with an OG VC who does not blog often, but when he does, he seems to set an agenda for like a decade, and that would be Mark Andreessen at A16Z. And so I just want to quote Packy's post here really quickly here, and it's going to bring me to one from Andreessen. So he's saying right now, a perfect storm of sentiment shift and technological progress that could mark the end of the great stagflation and the beginning of the great acceleration. Americans want to live in a country that builds things again, which brings me to in the throes of the pandemic, at the lows. This was April of 2020, at least in the markets, at least in the public markets, and maybe from a sentiment standpoint, when we were in, I think, what many people have called a black hole. No one knew what was going to happen. Mark Andreessen wrote this post, and I think it really was a shock at the time. It was basically a pretty brutal, kind of recount of how we got to where we are. Okay, the harsh reality of not heeding the warnings and then saying, it's time to build. And he said part of the problem is clearly foresight, a failure of imagination. But the other part of the problem is that we didn't do in advance, and we are failing to do now. And that failure of action, and specifically our widespread inability to build. And I think that's really interesting. Now, let me just tie this all together because it brings me to the Commerce Secretary, Gina Raimondo, okay, who many people feel very, very like they think that she is an up-and-coming star as far as in Democratic politics. But she's talking about this movement that she's had trying to get young people around the idea, like, we just put in this CHIPS Act. We are going to have hundreds of thousands of great jobs to build things like semiconductors here, okay? But it doesn't feel like Americans, or at least Gen Zers or whatever, want to build here in America. They want to do these kind of—
They want to build their audience. Influencers, man.
That's exactly it. So let's tie all of that together a little bit, because you're always out there looking for talent, whether they be for people to come work at FirstMark, whether they be to invest in new ideas. You guys invest early at the seed stage, right? You're looking for young folks who have great ideas, right, that you want to invest in for probably decades. And I know that you've invested in individual founders multiple times, right? Like that sort of thing. But it doesn't seem like these kids want to build right now. They want to do the hard jobs. They want to, like you say, they want to build.
I don't want to get on. We could go to the rail of immigration, but that'd be hard. I think that I think that America is a great place because a lot of people come from all over the world because they think it's a great place in which to build, and I think that that's part of it. But we're not going to have we don't have the labor today and the skilled labor today to fill those jobs. And that could be, engineering and making chips, or that could be, providing healthcare. And you have to hope that there's some way for us to be able to provide the skilled labor we need for basically kind of the redomestication of a lot of our hardware over the next 10, 20 years. And people are talking about everything from rare earth metals and being able to mine those and use those here for things like electronic vehicles, all the way through being able to make our own chips and being less reliant on Taiwan, and therefore less fearful of China, into tying some of these mega trends together. But do we really have the people, and are we producing enough engineers? Are we producing enough people who are ready, willing, and able to be really excited to go to Ohio and work in a chip factory? I hope so. I think those are going to be great opportunities. They're going to be much better opportunities than I guess that generation's grandfather had. in the last manufacturing boom in America. But really hope that's going to happen, and I'm hoping that it's easy to announce factories to be built, and there's obviously beautiful, great ribbon cuttings around that. I hope that people, especially the politicians, are following through with what else needs to happen. That's less ceremonial and is more long term in terms of making sure those people have the right skills, are doing the right things, and we're setting ourselves up for long term success.
All right, last thing before we get out of here, because you talked about, your personal interest, but also FirstMark in investing in healthcare, and you see this as a mega trend that, technology can just, change dramatically over the next few decades. And, I just want to remind our listeners, and they know that Row, which is a company that you were a very early investor on, you're on the board of. Zach Rotino has been on the pod recently, the CEO and founder, and we've been talking a little bit about my experience with Row Body, which is a program that they instituted earlier this year. It's focused on some of these weight loss drugs that you guys all have been hearing about. We're recording this on Tuesday morning. And shortly after the opening, and Novo Nordisk, which makes Wegovy, which is the drug that I have been taking through the Row Body program over the last 6 months, I've lost nearly 35 pounds doing that. One of the reasons I started on the program was I was focused on my health broader, not just the fact that, I was 6'2", 226 pounds, not not massively overweight, but just given like a whole host of things, I got to, probably my max weight there in the pandemic. And, a lot of those sorts of things kind of played into that. But a lot of my doctors are saying, you got to lower your cholesterol, you got to lower your blood pressure. And guys, this is all my experience. Okay. So I'm just not like making,
but I don't think that's dissimilar from most Americans. People could stand to lose a few pounds, and being overweight really shortens your life.
Right. But so it's not just that, so my doctors were saying you gotta do things to work on your sleep apnea, right? So the cholesterol, the blood pressure, all those sorts of things. So, losing nearly 35 pounds in 6 months on this program, I mean, for me, it's changed my life. And you and I have talked about it a lot. But when I see a headline like today, okay, so there was a major study, it was just released, obesity drug Wegovy cuts risk of heart attacks and strokes by 20%, okay? So the stock is up 15% on this, and this is why we're talking about this right now.
And remind everybody, what's that total amount in terms of billions of dollars of market?
So Novo Nordisk is now nearly a $420 billion market cap, and I just want to remind people that Pfizer, which created obviously the first vaccine that was approved, is now a $200 billion market cap. Just think about that. So we had this, and Moderna has retraced all of its gains, okay, from what it did in the pandemic. And listen,
but just remember, so Novo has gained $50 billion in market cap in the last 5 minutes because of this drug. So it's truly, all the data that's been coming out. I wouldn't say all the data, nothing's all or nothing, but a lot of the data coming out is saying that this drug has very limited side effects. This drug helps you lose weight. By losing weight, you are going to increase the quality and quantity of your life. And this might be the next wonder drug where there's a fair portion of people in the world who take this for a long time. And it's the beginning of the reversing of this terrible obesity trend, which we've seen for the last 40 years.
And just to put a finer point on that, so Eli Lilly and Novo Nordisk, they nearly have a combined $1 trillion in market cap. And a lot of these gains over the last, call it, year or so have been powered by these drugs. And when you see studies like this, and it's saying that if you're obese and you're taking this drug, it reduces the chance of potentially reduces the chance by 20% of heart attack or stroke. I mean, this is one of the main reasons why at 50 years old, at my max weight, I wanted to do this and get a bit more healthy. So it's done all that. And so this is
looking good, feeling good, top of the world.
I see what you did there. All right, Rick Heitzmann, I really appreciate you coming in. A little bit of a pulse check on the private tech markets. A little
things are looking up slowly but surely. You're seeing the green shoots.
Well, I'll tell you one thing. I think the first time you came on the pod with Guy and me, it was on the tape, and it was at some point in late 2021. And you were like kind of pessimistic at a time where a lot of people were optimistic, at least on the private markets. And I know you were on the public markets too, because we were talking, the Nasdaq at the time. And you've been kind of cautiously optimistic over the course of this year, at least looking into your portfolio and some of the trends that you're seeing, maybe some of the kind of conversations you were having with LPs, with peers, that sort of thing. So it's been a really interesting almost 2 years as we've been talking about all of this. And it'll be interesting to see how it plays out if we were to see public markets basically kind of take a little bit of a dip and see where the private markets go, given the dry power, given a lot of the revaluation, giving some of the different sentiment shifts that we've seen and trends so far. So, Rick, we really appreciate your contribution to the pod, and we hope to have you back again very soon. Thanks, man, for joining us.
Thanks. It was awesome.